All right, so my plan for today is to actually go over this backwards. I'll go through the quiz here and start with questions like this to make sure we get to them, because I think we'll want a little more time to practice these questions. Logicking through the F portion of the P equals F over Q plus V and discerning between the VI and VE, I think we'll want some time to get used to that or refresh what we can refresh from chapter 3. So I'm going to go over this last part first, these kind of questions, and then make sure we have time on this. And any leftover time or as much time as we have questions from you directly, we can look into prior chapters or questions you have on the final exam review, or we can try to pull up final exam review, and if something pops out to you as like, hey, that's a real good question for us to look over, we can do that. Yeah. Yes, I'll be here. All right, so here's a conceptual question. An investment opportunity but it has to do with that second part, the ROI / residual income. So an investment opportunity has an expected 20% return on investment, ROI. The firm's cost of capital is 15%. So from the firm's perspective, should we accept that or not? We should accept it, yeah. As far as the firm is concerned, no other information, that sounds like a profitable investment for the firm to make. Which of the following is likely to happen if the firm uses return on investment as a performance measure of the investment center manager? Okay, so now we're talking about, well, maybe using ROI as a performance, that's a typo there, performance measure, an incentive, or the measure by which we decide whether you get incentives or not, could create some conflict with that idea. So number one, the manager may reject this otherwise profitable project if his or her current ROI is higher than 20%. Well, that seems to follow what we said on Thursday. That's kind of the donut hole of moral hazard that we enter when we use ROI, and we can have when we use ROI. Because if the manager already has an ROI higher than 20%, then this investment actually would reduce that manager's ROI and either directly reduce his or her bonus or increase the risk of not reaching a bonus or incentive or something like that. So this looks like a really good answer right here. Let's just double check with the other ones. A manager will not reject this project because the cost of capital is lower than ROI. I don't know if I really want to hold managers to that level. In fact, as a rational economic agent, they really shouldn't be worried about whether it's below the cost of capital. They should be worried about their personal ROI. That's what agent theory says anyway. All right, number 3 here, or at least as we have covered it in the book, this is not a correct answer. I'll say it that way. Is that okay? All right. Manager will reject this project because the cost of capital is lower than the ROI. It's saying something very similar. Well, it's saying that the manager will reject the project, but why would it be? Why would they? This option here doesn't make sense, because if the cost of capital is lower than the ROI, that actually sounds like there's room there for a profit above and beyond what it costs to have the money to invest. So this doesn't make sense just internally. It doesn't have any internal logic here. All right, lastly, ROI ensures managers invest in all projects that are profitable to the firm. And that's not true. At least that's the point I'm trying to make with this section of the chapter. So that first one is the right answer for that question there. All right, let's look at this question here. An investment center within a firm has the following data. So it is expressed in present value. So I'm not having you do any movement to present value or any calculations like that. Just assume it's already in present value. And even if it doesn't have that parenthetical, just assume that throughout all questions. It's possible I miss one or two. We're not doing time value of money here. That's not the learning objective in this slat of questions here. So it has profit of $188.1 million, firm cost of capital 7.5%, and operating assets of $1.6 billion, basically. Okay, so that's the investment amount. And if we recall, residual income is our profits minus, and I'll put parentheses even though I don't need to, the investment amount times cost of capital. Yeah, from a math perspective, I don't need these because order of operations would have these two be multiplied anyway. But it's useful to say, this is the amount to kind of break even on a capital expenditure point of view. So we've got to invest a certain amount times the cost of capital. That's the amount of profits we have to earn from that investment for it to even break even and have an ROI equal to the cost of capital or have a residual income of 0. So any profits above and beyond that is a positive ROI. And if profits are less than that, then it's a negative RI. I said ROI just a second ago, but I mean residual income, RI. Okay, so we have profits of 188.1 million. I'll pull out the spreadsheet now. $188.1. Well, almost. All right, profit. We have 1643.1 in millions for investment. And we have 0.075, which is 7.5% as our cost of capital. So the parenthetical, this is the within parentheses portion of the equation. And the profits minus that portion of the parentheses is the residual income. All right, so that should be the answer we get. Yep, there it is right there. I mean, I could code it entirely in one cell, profit minus investment times cost of capital, and literally have it map up to the residual income equation right here, and I get the same thing. Yeah. Yep. It's kind of the profit that the investment has to make to break even is the idea. Yeah. I don't have to. I broke that out. I don't know why I did that separately. I just probably you're going to want to do it this way, just for simplicity. All right. One thing I'll say is we can rule out a couple answer choices right away. Residual income is a dollar figure. So, if your paycheck comes back and it's like, on your paycheck, we're going to deposit 11.4% in your bank. You might be working for a scam. So don't do that. So yeah, it's going to be the dollar amounts here. ROI could be expressed, ROI could be expressed as a percentage here, but RI is going to be either A or D in this case. Okay. We'll do it again. One more residual income rep, because this is a different style of question, different style of question. You have to solve for residual income. Well, let's step back for a second. You can do this two ways. We could solve for residual income, or we could actually solve for ROI and infer what the residual income is going to be. I'll tell you the two ways here. This is a RI question with interpretation. With incentives interpretation. So the idea here is the question says, based on project residual income, is the manager likely to accept the project? So if the manager is incentivized based on residual income, at least in part, where does that push the manager to accept or to reject the project? And then there's also a why. So the question answers could be yes here, A, or yes here D, but for different reasons, and no for B and no for C, also for different reasons. So we got to figure out what's going on here. We could solve for RI, residual income. I'd like to say that out, because otherwise I just end up blending RI and ROI, and it becomes really unclear. We could solve for residual income. Very, very simply just doing the same thing here. Get rid of these two, just do this. So change the data. We have 93.5 million in profit. We have 550 million in investment. We have 15%, which is 0.15. So the residual income is $11 million, which means that it's profitable. That means that if you're going to set up an incentive with residual income, you're going to say, well, you get a bonus, or you get more of a bonus if you have a higher residual income, more positive. So that says this right here. So that's nice and easy. We could solve for residual income. We could also, if ROI just comes easier to us, we could just say ROI, which is profit over investment. And so the ROI is 17%. That 17% is greater than 15%. That means we will have a positive residual income. It's impossible for it to be otherwise. 17% ROI from cost of capital 15% means that the profit here is going to be greater than the amount we need to break even, basically, that part in the parentheses. So if ROI comes very quickly to you and you're like, oh yeah, I can divide real easy, that's fine. One less mathematical step, and you can just say 17% versus 15%, residual income is going to be positive. We can say, yeah. We don't know the amount by which, but the question isn't asking for the amount, just for the incentive outcome. Yep. So
the ROI is profit over investment.
Yeah. We're using real simple definitions, no tricky business. I'm not trying to trick anybody here about things. I know there are different ways. Some people have particular definitions of profit or income they like to use in the numerator, particular definitions of how to assess the investment amount, like the average of beginning versus ending assets, or the ending assets, or some other measure investment, like there's a specific economic value added, which is like a form of this kind, one of these kinds of measures. I'm trying to make it very simple. Yes, just profit over investment is what we're looking for.
But in real life, there's a chance this manager might not accept that 17% is below 20%.
Yes. In real life, that's in real life, if he or she is being incentivized based on ROI, the point of this part right here is to say, focus on the residual income effect on the manager's incentives. So as far as residual income is concerned, the residual income of this project is going to push that manager to accept it, is the idea.
So would it be because project ROI is greater than the cost of capital?
Oh, sorry. So a similar question. I thought you. Yeah. Is it because project ROI is greater than the cost of capital? That is true, and I think that's one. That's possibly the answer to the question. You're looking at a different question that's similar? Very similar. Like same numbers and everything? Okay. Does it say like based on ROI? Okay, so based on ROI with the same numbers here, assuming that question is the same numbers or whatever, based on ROI, like Eltian said here, actually, no. If there's no measure for residual income, I'm the manager and I say, well, I got 20% ROI right now. I don't want that measly 17% ROI pulling my ROI down. So I'm going to reject this project, or I am likely to reject this project. Does that make sense?
Yeah. This doesn't really give the quiz, but what if it said instead of like manager, it said like the firm in general?
Yes. Yes, exactly. The firm wants to accept non-mutually exclusive projects that are greater than its cost of capital. Yeah, if it can accept as many of those as possible, then that's more profit. Yeah. And so yeah, this residual income helps align the two better, the manager and the firm. Yeah. Up here? Right here? From? I think did you spot that question on your quiz there? Gotcha. Okay. I've done my best to stick by the idea of I'm not trying to trick you into these questions, but they're designed to have you learn a couple simple equations, just ROI and residual income, and understand where they push managers' incentives versus the firm's incentives. I think if you have that pretty solid, then you can go through the questions and they should largely jump out at you as one thing being right or the other. Okay? Is that good coverage of ROI and residual income for now? Jump to transfer prices? Yep.
Wait, so is ROI profit over investment?
Yep, it is, yeah. All right, let's look at a transfer price question. Let's start here. So this is a decent one. It's fine. The firm Lancaster produces artistic timber works and uses negotiated transfer prices for its two departments, chiseling and staining. And for some reason, I wrote an essay about it. The timber works are chiseled and then stained. The staining department can purchase chiseled timber works through the external market for $15 per cubic foot. All right, so that's the external price for the buying department. The staining department can buy on the external market $15. So if we were negotiating, that had to be the ceiling, right? Because sometimes these questions have a lot of information, and at the bottom they say, what would the maximum price be? And you're like, oh, I gotta do all the equipment. No, stop. I already told you the ceiling. Just remember that. If this right here said, what is the maximum price for negotiation? You would just say, well, I know it, 15. Boop. Next question. You have to make that sound though, or it doesn't work. The chiseling department can sell its timber works through the external market for $18 per cubic foot, which is relevant if we have to push external market players out because of limited capacity. If we don't have to, if we have plenty of excess capacity, then it's going to be irrelevant. Because the external market price for the selling department helps determine its contribution margin per sale in the external market and how much it's losing by pushing external market players out to fill the internal needs here. All right, it costs the chiseling department $5 of variable cost per cubic foot to chisel these timber works. Okay, that's our variable manufacturing cost right there, $5. It also costs the chiseling department $2 per cubic foot to ship chiseled timber works to buyers on the external market. Okay, so those are our variable costs on external sales, $2 per cubic foot. The chiseling department has effectively $0 in fixed costs, which we would ignore anyway. I've simplified the question there for you. So the chiseling department has 500 cubic feet of excess capacity. The staining department needs 4,500 cubic feet of chiseled timber work. All right, so we're going to have to kick some regular paying customers out, some external market customers out, right? Because that is not enough to fill that level of demand. 500 cubic feet of excess capacity, not enough to produce the 4,500 required by the staining department. So we can tell right there, we can subtract those two. So let's go with transfer price question 1, Lancaster minimum price or floor. So we can tell right away, 4,500 is Q, the quantity demanded. 500 is our excess capacity. So we're going to have to lose this number of sales, 4,000 in sales. All right, let's copy down some of the other information we got. So $18 is our I'll call it the price on external market. This is the selling department, yeah. We have $5 of manufacturing variable costs. It's our VI, V sub I, subscriptive I there. Variable costs that are internal to the firm. We have $2, which is our external sales variable costs, or VE. And that's it. So for every external sale we make, we should be earning $11 of contribution. So that's the $18 price on external sales minus this $5 it costs to make minus the $2 it costs to ship or sell externally. So this is our unit CM, and units are in, everything's in cubic feet. Unit CM for external sales. So that means lost contribution margin from internal demand. Call it that. That's also our F. So P equals F over Q plus VI. That's our equation here for price floor. So we have F divided by Q plus the internal variable costs. So that'll be our floor. It's not a lot of negotiating room there. Ceiling of $15, floor of $14.78. Yeah, here I'm just saying we're losing 4,000 sales to fill the internal demand, and we lose 11, or we would earn $11 of contribution per sale. So we end up with the product of those 44,000 as our total loss contribution margin for selling internally, kind of taking the special order from our internal department, if you will. Same logic. The only difference between what we did here and what we did in chapter 3 is because it's internal versus external, some of the variable costs don't apply. So our internal, we leave out all the external variable costs. We only have VI right here, but we do include them when we figure out the contribution margin lost for external sales. Okay. Yep. So you can increase your guessing odds by 8.3%, 16.78 as a floor. Maybe I would be tricky enough to still ask you for the floor, even though the floor makes it so it's economically unfeasible. But I think usually if that were the case, I would say no transfer price possible or something like that. Yeah.
We ignored the information in regards to the staying department on this question because it's all the other information and the question is asking about the just department, correct?
Yes. Yes. The staying department's the buying department. The only thing we need to know about them is their yeah. Well, sorry. Yes. Two things we need to know. We know how much they want, and then what they can get it for in the external market. We don't even need this for this question. Sorry. The only thing we need them for this question is indeed yes, the demand that they have. Yeah. In general, for transfer pricing, the things we need from the buying department are what their alternative price is and how much they want for it internally. How many they want internally. Yeah. If I can say the words. This whole talking thing, it's new to me. Okay. So what if we had excess capacity of 4,500 or more? What would our floor price be? Now you got to do long division in your head, don't you? You don't actually. Yeah. Almost. It's you're right to pick out just the number up here. It's this 5. It's just the VI. If we have excess capacity, we can fill the entire order without kicking out any regular paying customers. We've lost 0 sales, which means there's no fixed cost to taking the order. There's no fixed cost to selling internally. So some of the problems will have plenty of excess capacity. And when that's the case, you can say, yeah, I got a golden ticket. That's great. Now I can go to variable costs. That's it. In that narrow case where there are no fixed costs, there's no limited capacity, then you just look at that internal variable cost, and that's the floor. Or variable manufacturing costs, it's sometimes called in the problem. Okay, let me put this. Ooh. There, put that back. All right. Okay, this is more the setup typical of these questions. Oh, hey, here's a question just like this. The fabrication department has excess capacity to produce 5,000 units of a key circuit board, which has the details below. Market price, $48. Variable selling / distribution cost on external sales, $5. Variable manufacturing cost, $21. Fixed manufacturing cost, $10. The electronic assembly department needs 4,500 of these circuit boards. It can buy them externally for $46 each. What is the minimum transfer price that would be negotiated for the circuit board? So this is one you can do without any calculations, although you might still be tempted. It's 21, that's right. It's 21 because, let's look at this equation right here. P equals F over Q plus VI. That's the price floor. F is going to be 0 because we have more than enough excess capacity to fill the entire electronic assembly department needs. And then some. And so there is no fixed cost. F is 0. So 0 over Q, which whatever Q is, it's 4,500 is going to be 0. 0 plus VI. So it's just the VI, well, which is this right here. Okay. Don't be tempted to include this. Just think about the fact that we're shipping it internally. We don't have to get it all fancied up. We might be shipping it like across the factory floor to the other side of the factory, not shipping it out to customers or things like that. So we get to avoid these $5 of variable cost and external sales. As a result, we're just worried about how much it costs to make. That's VI. Yep.
I have a question. It says the buying department needs 20,500 units of this input, but the selling department only has access capacity to produce 3,500. Would 3,500 be my Q and then the 20,000 be my excess capacity?
The 20,000 is going to be your Q. That's how much they need, right? That's how much the buying department needs.
Yeah, needs.
Okay, so that's going to be your Q, and then the difference between those is your excess capacity. Oh no, excuse me. The 35, the 30, say 3,000 or 3,500. The 3,500 is the excess capacity. They have excess capacity of that amount, right? Yeah, that's the excess capacity. So in that case, 20,000 or 20,500? 500, and excess capacity of 3,500. So that means 17,000 in lost sales. Lost unit sales.
So Q is our internal demand.
Yeah, Q is the internal demand, yes. Yeah.
So it's the same
And then-
question except for the electronic assembly department needs 6,500 instead of the local.
Okay. All the other numbers are the same? It is asking for a minimum? Okay. Let's do that. What I'm going to do is I'm going to grab this information here and copy it down and fill it in. Because now we're going to need more calculation. Since we have demand or Q that exceeds 6,500, you said, the excess capacity. All right, so this is the only difference. This is Q based on student question. Just wanted to make sense if you look at this later and you're like, I don't remember how this came about. Okay, and everything else is the same here. So we have as this question. So we're going to copy them over. $48 market price. 21, I have a slightly different order. 21 is the VI, manufacturing costs. 5 is our variable cost on external sales, which means that our unit contribution margin on external sales is $22 in this question, which means, we have $33,000 of lost contribution margin total. That's our fixed cost of selling internally. So that's F, this is Q, and VI, you said, is the same as in this question, so it's 21. And so we should be able to use that same equation there. F over Q plus VI, $21, gives us a floor of 26.08, it would round to. Is that one of the answer choices?
Yeah.
Good.
Could you show me how you got the
Up here? Right here? Oh, not here. I just took the price minus the two variable cost figures. This is the one time that the external sales variable costs plays a role, the VE, when you're determining unit contribution margin. That's the one time.
And fixed costs just ignored.
In these questions, always ignore fixed costs. It's kind of a theme, honestly. We often do that. And no problem. Okay. Let's see what else we can do here. Well, I like to go over the conceptual questions. Let's try this one. Which of the following is true about transfer prices? For a negotiated transfer price, the minimum price, the floor, likely increases as the buying department's market price increases, assuming limited capacity. I don't know if I can see any reason that would be true. At least not directly. So the buying department's market price is not directly affecting the floor here. It's possible, but that you have some sort of macroeconomic explanation for why that would be the case. But let's leave that aside. Nothing in the calculations we're doing requires that. The selling department's market price might make a difference on things, but not the buying department's market price for the floor. Buying department's market price gives us the ceiling, because that's not right. Sorry, that's not right. Transfer prices mainly help ensure investment center managers choose capital products that are in line with the firm's interests. This is me hoping to confuse you about transfer prices versus the other question type, ROI and residual income. No, transfer prices are not about investment center decision rights and investment center managers. That doesn't have to do with that. See here, letter C, this question here is answer choice here. For a negotiated transfer price, the minimum price or floor likely decreases as a selling department's market price increases, assuming limited capacity. All right, so this is a possibility. So does the minimum floor, the P, go down as the market price increases? So if the market price increases, that's going to, with everything else held constant, probably increase our contribution margin per unit. So each of the lost units is going to cost more and more and more. So F is going to get bigger. If F gets really, really big, does that drive P high or low? It drives it up. It means more. It means I gotta make up more for these lost sales. So this isn't true because it's backwards. The increases here and decreases here are incorrect, or at least they don't match. Minimum price likely increases as the market price, the selling department's market price increases, assuming limited capacity. If we had no limited capacity, there wouldn't be a difference because we're just picking out that VI because fixed cost is 0. We have no lost sales to multiply the CM by. This just equals 0. So it would make no difference for the minimum price floor if there weren't limited capacity. Okay, so this last one by process of elimination has to be right. For negotiated transfer price, the minimum price, i.e. the floor, likely increases as the selling department's excess capacity decreases. Okay, so similarly, this part right here, this in calculating F, we have two things that are being multiplied by each other. The lost sales times the contribution margin per unit. And what we're saying is, as the excess capacity decreases, that means we're losing more and more sales. So, like for example, if we had instead 3,000 units in excess capacity, our prices went up because we have lost far more, we have to kick out far more units worth of customers, which means that our total lost contribution by selling internally goes up. That's a higher F that increases the floor price. So there it is before the change. If you decrease capacity, there it is after the change. Until ultimately, if you have 0 excess capacity, it equals the price minus, it equals what is that from? Let me make sure I've articulated this just right. It equals the price minus the external costs here. But the point is it gets up to that highest amount it can. Okay, so this answer is right here. Okay? Is that all right? Should we do both the open answer? Because we like to do the open answer questions. We like to go over the open answer questions. Say that. That's more truthful, right? Okay, so we're going back to the ROI and residual income idea here, and then we'll come back again. We'll go back, a reverse, double reverse like in Uno, to transfer prices right here. All right, so a firm is considering multiple projects. The firm's required rate of return is 14%. That's the cost of capital, the hurdle rate, or whatever you want to call it. This is the only term we use, the only concept we're using for these multiple terms is this 14%. All right, so we have two projects with income or profit and investment. Investment and income right here. All right, the firm picks the project with the higher ROI. What is the ROI of that project? So what we have to do is we have to figure out the ROI of each of these two. This is the ROI question, open answer. So the ROI, how would I calculate the ROI for project A? Right, income over investment. I flipped them around how I wrote them here just to be extra tricky. But yeah, you take the income amount, profits, over the investment. And you do the same thing for project 2 here, the income amount over the investment. So it looks like they would have picked this one right here, project A. It has the higher ROI, so we are going to copy that over. We're going to round it a second decimal place, it says, and leave it in decimal form, not as a percentage. So 0.19. Is that okay? All right, let's go this one. So a firm uses negotiated transfer prices to transfer costs from the seller department to the buyer department. I literally named them seller and buyer. Buyer department uses a key input from the seller department. Buyer department can buy this good on the external market for $112 per unit. And at this point, if not before, I've checked to make sure that the question stem isn't asking for the ceiling, because if it were, I would just copy that 112 over. That's the ceiling for our negotiations. But it's not asking for the ceiling, it's asking for the floor. So I got to grab this equation in my head at least. The seller department assigned the following per unit costs to each unit of producing this input. Okay, $21 direct materials, $28 of direct labor, $20 of variable overhead, $14 of fixed overhead. Okay, so these would be our variable manufacturing costs, these three that I've highlighted, DM plus DL plus VOH. Okay, we can ignore the fixed overhead amount. The seller department has limited capacity. They have capacity of 1,000 units per period. So their overall capacity is 1,000 units per period. I've formulated this slightly differently. The question's stated a little differently, this part here. External market demands 500 units, or we can sell 500 units at a price of $97 per unit. Buyer demand is 700 units per period. Okay, so our excess capacity is our total capacity here minus what we sell to the external market. So 1,000 minus 500 gives us 500 units of excess capacity. So we can start from that point with basically the same setup as here. This is stop highlighting it. I also want to label the question. So this is transfer pricing. Open answer. All right, so we have 700 quantity. We have excess capacity of 1,000 minus 500. It's going to hard code that into the cell. Okay, that's where that comes from, this overall capacity minus the 500 external sales units. And so that means that we have to kick out 200 units worth of external customers to fill the buyer department's demand of 700. So those are lost sales. We're going to figure out how much they cost us. We're given in a parenthetical here how much we can sell on the external market, $97, how much we can sell units for. And our manufacturing variable costs or variable manufacturing costs are the 21 plus 28 plus 21. Just these three numbers right here. DM, DL, and VOH. There's no indication we have any variable costs for external sales. I'm going to leave that as 0 here. So our unit contribution margin is this 97 minus the 70. So we get $27 unit contribution margin for external sales. We multiply that $27 times the 200 units of lost sales that we have to get the total lost contribution for kind of accepting the buyer department's order of 700 units. So we have $5,400 of lost contribution margin. That's our F. It says over here. And we can put F here over Q plus the VI, which is this $70 right here, which is a sum of 21, 28, and 21. And we end up with a floor of 77.71, it would round to. Yeah, we're going to always ignore fixed costs in these examples, yeah. Not to say transfer prices overall, always ignore them. There are the 5 bullet points or 5 numbered things in the textbook to talk about different ways of doing transfer prices. Not that companies always ignore them. We are always going to ignore them in this class because we're always worried about negotiated prices. That's the 5th of the 5 answers. Some of those include absorption cost, which would include the fixed costs that have been absorbed. But when we're doing negotiated prices, the floor is going to be based entirely on the variable costs, so you ignore the fixed overhead. Yeah.
So if it said nothing about the capacity problem, it says it has good capacity, it would just be the direct material? Or?
It would just be the sum of these three.
Oh, okay.
It would be because together they make the manufacturing costs. One of the definitional things that popped up in my mind is we've got product costs and manufacturing costs. They're synonyms, really. And they mean the direct costs plus overhead. So the direct costs are materials and labor plus or overhead, which can be variable or fixed. And so when we say variable manufacturing costs, for the VI here, we need to include all three of those is the idea. So that does kind of harken back to way back when I had the big rectangles and the dashed lines and the definitional ideas of categories of cost based on their traceability and directness with volume. But that's the short answer is it's the sum of these three. Yeah. Okay. Because more to your point, if we have plenty of capacity, we don't have a limit, then we have a 0F, which means that it's just P equals VI. So we're just calculating VI, which is to sum these three. Yep.
I have a question about ROI and residual income, but it's a conceptual question.
Okay. So let's go ahead and submit this one. We'll come to your question there. Let's see, we answered everything but one. That looks like we got everything but one right. Good. Okay, let me see it. Let's see if I can. Okay, well, let's see if I can find that very question. We'll see how much luck I have, how quickly I can do that. Not true is a phrase that's in there, right?
It's false.
Oh. False. You like question 4? Okay. Well, since it's here, let's go over that one, and we'll come back to that one. Which of the following is a shortcoming of residual income? Okay. Residual income does not take into account the firm's cost of capital. It does. So that's untrue. Residual income cannot be easily combined with other performance measures such as return on investment. Actually, that's like the only way it gets used as an add-on to return on investment. Usually firms don't take away ROI. They say, here's an ROI incentive, and here's a kind of a rider to your contract that also says you have to reach this level of residual income, or we're going to add extra bonus the higher your residual income. We're going to add on to the ROI. So no, it can be combined, and it usually is. Higher residual income, so that means this is false. Number B is false here. C, higher residual income might only indicate a larger but not a better performing department. Okay, that's me being sneaky and saying it doesn't scale the same like ROI does. And that's something that is true from the textbook that we talked about in class. ROI's benefit is that you can compare things that otherwise wouldn't be comparable. You can take a farming enterprise and compare it to a manufacturing enterprise and compare it to a service enterprise. You can take an accounting department inside the firm now and compare it to an IT department, a production department. They all got ROIs potentially. Various departments of various sizes of different regions, you could say. Maybe a very small region, just developing, versus a very robust region. They still have an ROI you can compare them on. Residual income, though, if you have a really high residual income, maybe the department is just bigger. It doesn't mean that they did so much better. They might just be bigger. So this actually is the right answer here. Does that make sense there? I'm just trying to disguise, not say directly what's in the textbook. I'm trying to say something that is true because of that thing in the textbook. Last one says residual income leads managers to reject projects the firm would rather they accept. No, it actually does the opposite of that. The purpose of it is to help managers accept as many of the projects the firm would like to accept as possible. To help with that, make it more likely. So that's the answer right there. Is that good for that one right there? Let's keep looking for the false one. No. Whoa. Is this?
No, it's ROI.
So close. No, we'll keep going. Let's take us a minute here. Does it say right here? Okay. I was tempted. I was almost about ready to just go over there and just read it off the screen. All right. Which of the following is false about ROI and residual income? Okay, so it is the first A here. It is easy to use residual income to compare department managers regardless of department size. That would seem to contradict what I said before. Residual income has a comparability problem. ROI does not. It's its strength. Its greatest strength. So this seems to be false. This says it's easy to use residual income to compare department managers regardless of the department size. So I want to click that one, but I'll double check the others. ROI and residual income are most likely to differ in their recommendation when an investment center manager's previous investment decisions have worked out very well. All right, me being tricky again. If your investment decisions have worked out really well, does that mean you as a manager likely have a high ROI or a low ROI? You probably have a high ROI because you've done really well. And so that means it's more likely there's a big donut hole between your ROI and the firm's cost of capital. And that's more and more likely that you're going to get an ROI recommendation which says no, reject projects that are in this donut hole here. Whereas residual income will say no, accept everything above the cost of capital. So it's more likely that so the answer is yes. They're most likely to differ. And so this statement is true, which means it's not the right answer for the question, which asks which one's false. Okay, so B is eliminated. C here, residual income takes into account the firm's cost of capital. Also true. It's right there. D, using ROI can motivate managers to make decisions that are not in the firm's interest. Yeah, it can, because of the big donut hole. I don't want to reduce my personal ROI with that project that the firm would consider profitable, but me personally, it increases my risk of not making bonus. All right, so there is the false one of those four. Okay. All right. Let's double check, make sure, just in case. Oh, good. I'm not taking crazy pills. We got that one right. So let us jump over to this lovely piece of work. So I want to make an acknowledgement. I know it is long. I know this quiz has 25 questions and is very long, the review quiz. I know it's for points. Before you take it out on me in the course evaluation that you will be incentivized to give now with extra credit, and I'm fine having that in the video because I'll open that up to the online people too. I'll make them have a similar incentive. So they'll write their thank you notes to you. I started a sentence and I stopped. I didn't. I know it is. My acknowledgement is I know it's a very long one. The trade-off is that you're going to try and get your 50 points or as high a points as you want on this. It's going to take a long time, but you're literally taking every time you take an iteration of this a practice final. So when you get to the final on your first or second attempt, you'll be like an Olympic level final taker for the class. It reduces reduces some of the friction that could come in there in transferring from the quizzes during the course to the final. And that is one of the reasons why it's useful to have this extra credit here and why I'm amenable to it, because if it's going to take you an hour to do another attempt and you've got like 48 out of the 50 points, then I don't know how long it takes you to go through the 25 questions. 2 hours to go through the 25 questions. Then yeah, maybe you rely on the extra credit from the course evaluations. Once we get to a certain level of participation. Okay, so let's look through and see if there are any that jump out at us here. There's a keep or drop decision. Call out and make you stop if you want to look. Oh, boy, there's oh no way showing up. That was from chapter 8 here. Hutchison Unlimited. What is this? Sales makes the cost structures. What are we doing? We are doing chapter 3 question. got to figure out a target revenue to reach target profit. Okay, wait, did I hear somebody say something? No? Okay, I'm trying to listen. Here's an activity-based costing question. This is a first stage allocation question. Try to get you to build an activity cost pool. Here's a TD ABC question. All right, here's ABM question, activity-based management. Which customer is most profitable to the firm based on ABC information. Okay. Oh, chapter 6 question. Weighted average. Looking for a cost rate. Now, if you really mean you want to have me do the chapter 6 questions, because I think I put that part of my brain on standby for a while. I might have to think for a second if you have me do one of those. More chapter 6. This one also for looking for a cost rate. Oh, we got lucky here. Good arrangement here. A direct materials cost rate and a conversion cost rate. Another weighted average. This time looking for the applied cost, the total cost of ending work in process. Ending wet balance. Using weighted average rates. We have FIFO, looking for a cost per equivalent unit. FIFO looking again for a cost per equivalent unit. FIFO applied cost question for total cost ending WIP. FIFO question for total cost for units completed. Okay, we have 7-1 direct material usage variance question, or standard costing question is the idea. A journal entry related one. We have a fixed overhead volume variance question, a mix variance question, catching back up to the present here. Direct costing, chapter 8 question here for backflush. Got a conceptual question here about value stream income statements. We've got one of those capacity variance questions. Okay, another conceptual backflush costing question, conceptual transfer price question. We got a ceiling, maximum negotiated transfer price. We can answer this real quick, right? It's 1,000, yay! Real quick, yeah, the buying department can buy it externally for $1,000. That means that's the ceiling. Okay, here's a service department question, service department cost allocation question. Here's another one of those. Okay. So like right in order. Although for the most part, yeah. And the answer is yeah. I think it does. Which helps with. I've been trying to prep you to say, well, don't confuse this with an earlier chapter, and maybe it helps you access certain areas. All right. I think we can do one question basically, or none. I didn't hear anybody. I didn't recognize anybody jumping out saying a question as we went by them. Just start at the top. All right, let's do the first one. Okay, so we have two departments, first and second. We might try to drop the second department. We have some revenues and some costs for each department. So let's put those in. This is a review quiz. First department, we have its revenue, 100,121. We have 52434 variable costs. We have 22,462 fixed costs. Nope, I want to do that manually. So revenue minus costs, that should be our profit for the first department. Second department, we have 217,770, 193,827, and 27,269. Same categories. I want to copy them. And same equation here. Take the profits to departments. That's our current situation. So that is keep, or the status quo. We also have the possibility of dropping. Think of dropping the second department. All right. So it says we could drop the second department, and that would mean zero revenue. Also zero variable costs, but looks like 8,965 of the fixed costs would stay. Also dropping the second department will reduce sales for the first department by 75.74, and we're going to assume no variable cost changes just to make the problem simpler. So this amount minus 7,574, and everything else stays the same. So how much more or less profitable is it to keep than to drop? So it looks like even though second department seems like it's a loser, it's got a loss right now, $3,000 worth. If we drop it, it's even more of a loser to us because there's a bunch of fixed costs we can't get rid of, and because it drops our revenue from the other department. So this is keep less drop. Keep profits less the drop profits. This is overall profit. Call it that. It is this amount more profitable to keep than to drop. Okay. That coming back a little bit. All right. Well, we'll go and stop there. I have some homework myself, things I'm going to send out and figure out. Yeah. Hold on, let me